Imagine selling an asset for a profit. It could be anything from a piece of real estate like your home to stocks and bonds you've invested in over the years. The moment you sell that asset for more than you paid for it, you've made a capital gain. That profit is your capital gain, and it's essentially the difference between the selling price and the original purchase price of the asset. This gain is considered income, and just like your regular income, it is subject to taxation. And yes, the government wants its share. This is where capital gains tax comes into play. It's a tax levied on the profit you make from selling your assets. The rate at which you're taxed can vary depending on how long you've held the asset and your overall income. That's where capital gains tax comes in. If you've held the asset for more than a year, you're typically subject to long-term capital gains tax rates, which are generally lower than short-term rates applied to assets held for less than a year. It's the tax you owe on the profit from selling assets like stocks, bonds, and yes, even your house. The rates can range from 0% to 20%, depending on your income bracket and the type of asset sold. Understanding these rates is crucial for effective financial planning. The good news is, there are ways to legally reduce or even eliminate this tax. Various strategies can help you minimize your capital gains tax liability, such as tax loss harvesting, holding on to assets for longer periods, and making use of tax-advantaged accounts. We're going to focus on one powerful strategy: buying another house. This is particularly relevant for homeowners who are looking to sell their current property and reinvest in a new one. This can be a game changer for homeowners. By reinvesting the proceeds from the sale of your home into another property, you may be able to defer or even avoid paying capital gains tax altogether, thanks to certain tax provisions. Understanding capital gains tax is crucial for anyone looking to sell their property. It's not just about knowing the rates, but also about being aware of the various exemptions and strategies that can help you save money. By knowing the rules, you can potentially save thousands, if not tens of thousands of dollars. Proper planning and strategic decision-making can make a significant difference in your financial outcomes. Let's dive into the specifics of how this strategy works and how you can benefit from it. We'll explore the ins and outs of capital gains tax, the various exemptions available, and the steps you can take to minimize your tax liability while maximizing your profits. Let's talk about the 121 exclusion. This is one of the most beneficial provisions in the tax code for homeowners. If you've ever wondered how you can sell your home and keep more of the profit, this is the key. The 121 exclusion can save you a significant amount of money, and it's something every homeowner should be aware of. This tax code section is your golden ticket to potentially avoiding capital gains tax when you sell your primary residence. Imagine selling your home and not having to worry about a hefty tax bill. That's what the 121 exclusion offers. It's like a financial safety net that allows you to keep more of your hard-earned money. It allows you to exclude up to $250,000 of profit from capital gains tax if you're single. This means that if you sell your home and make a profit of up to $250,000, you won't have to pay any capital gains tax on that amount. It's a substantial benefit that can make a big difference in your financial situation. Or up to $500,000 if you're married filing jointly. For married couples, this exclusion can be a game changer. It allows you to keep a significant portion of your profit tax-free, which can be used for your next home purchase, retirement, or any other financial goals you may have. That's a lot of tax-free profit. Think about what you could do with that extra money, whether it's investing in a new property, paying off debts, or simply enjoying a more comfortable lifestyle. The 121 exclusion provides a fantastic opportunity to maximize your financial gains. Think of it as a reward for being a homeowner. Owning a home comes with many responsibilities, but it also comes with rewards. The 121 exclusion is one of those rewards, offering you a chance to benefit financially from your investment in your home. But like any good reward, there are rules to qualify. You need to meet certain criteria to take advantage of this exclusion. These rules are in place to ensure that the benefit is available to those who truly qualify and to prevent abuse of the system. Don't worry, it's not as complicated as it sounds. We'll guide you through the requirements step by step. Understanding these rules will help you plan better and ensure that you can take full advantage of the 121 exclusion when the time comes to sell your home. We'll break down these requirements in the next section. Stay tuned. By the end of this series, you'll have a clear understanding of how to qualify for the 121 exclusion and how to make the most of this incredible tax benefit. Stay with us and let's unlock the potential of your home sale together. To unlock the magic of the 121 exclusion, you need to meet two main requirements: ownership and use. First, you must have owned and lived in the home for at least 2 of the 5 years before the sale. Second, the home must have been your primary residence during that time. You can't just buy a vacation home, live there for a few months out of the year, and expect to cash in on this exclusion. These requirements ensure that the exclusion benefits homeowners who actually live in their properties, not just those looking for a tax break. Now for the fun part, calculating how much you can actually save when selling your house. Let's say you sell your house for a $200,000 profit and meet all the requirements. This is a significant amount of money, and understanding how much of it you can keep is crucial. As a single filer, you can exclude that entire amount from capital gains tax thanks to the $250,000 exclusion limit. This means you won't owe any capital gains tax on that $200,000, which is a huge relief. But what if you make a larger profit? This is where things can get a bit more complicated. Let's say you make a $400,000 profit from selling your house. This is a fantastic return on your investment, but it also means you need to be more strategic about your tax planning. In this case, you'd still pay capital gains tax on the amount exceeding your $250,000 exclusion. So, for a $400,000 profit, you would be taxed on $150,000. Understanding these calculations is vital to maximizing your tax savings. Knowing how much you can exclude and what will be taxed can help you plan better and avoid any surprises when tax season comes around. It's always a good idea to consult a tax professional to ensure you're making the most of your specific situation. They can provide personalized advice and help you navigate the complexities of tax laws, ensuring you keep as much of your hard-earned money as possible. Additionally, using tax software or online calculators can give you a preliminary idea of your tax obligations. These tools can be very helpful in planning your finances and understanding potential tax liabilities. By being informed and proactive, you can make the most of your home sale and enjoy the financial benefits without unnecessary stress. Remember, the key is to plan ahead and seek professional advice when needed. Section 5. Navigating partial exclusions. When you don't meet the full criteria. Life happens, and sometimes you can't meet the full 2-year ownership and use requirements. But don't worry, you might still qualify for a partial exclusion. Let's say you had to sell your home after only 1 year due to a job relocation. In this case, you could qualify for a partial exclusion proportional to the time you lived in the house. It's important to remember that partial exclusions exist and can provide some relief even if you don't meet the full criteria. Section 6. Recent changes and updates, staying ahead of the game. Tax laws are constantly evolving, and it's crucial to stay informed about any recent changes. For instance, there have been updates to the 121 exclusion in recent years, impacting the way capital gains are calculated and the eligibility requirements for certain homeowners. Tax professionals can provide guidance on any recent updates and ensure you're taking advantage of all available deductions and exclusions. Section 7. Common pitfalls and how to avoid them. One common pitfall is failing to properly document your ownership and use. Keep all records related to your home purchase, sale, and any improvements made. Another pitfall is misinterpreting the eligibility rules. Don't assume you qualify just because you've lived in your home for a certain period. Consult a tax professional to confirm your eligibility. Being aware of these pitfalls can potentially save you from costly mistakes and audits down the road. Section 8. Real-life examples. Putting it all together. Let's look at a real-life example. A married couple bought their home for $300,000 and lived there for 5 years. They then sold it for $800,000, making a $500,000 profit. Because they meet the ownership, use, and marriage requirements, they can exclude the entire $500,000 profit using the 121 exclusion. They owe zero capital gains tax. This example highlights how powerful the 121 exclusion can be when you meet the criteria. Section 9, the bottom line, making informed decisions for your financial future. Understanding capital gains tax, the 121 exclusion, and its intricacies is crucial for any homeowner. By making informed decisions, you can potentially save thousands of dollars in taxes and secure a brighter financial future. Remember to consult with a qualified tax professional for personalized advice tailored to your specific situation. They can guide you through the process, ensure you meet all requirements, and help you make the most of this valuable tax break.